Hi, I'm Tom Lydon with ETF Trends, and welcome to ETF 360. Joining us today is Dave Plecha, who's Global Head of Fixed Income at Dimensional Fund Advisors. Dave, great seeing you.
Thank you, Tom. Great to be here.
So as we embark on 2022, a lot of advisors are noticing inflationary concerns. They're noticing what moves the Fed might be making. When you talk to advisors and when they're talking about portfolios, what are some things that you're hearing today?
Well, a lot of talk, as you said, about inflation. Of course, a lot of talk about the Fed. And my question back to advisors when I talk to them is, what part of that story do we think is not already reflected in current prices? You know, all market participants are following the data minute to minute and acting on that data. So it's not about, you know, where we are in the interest rate cycle, because we think that's all priced in. It's really more about what's the right place for your clients to be in the fixed income portion of their portfolio.
Yeah, we talked earlier, it's all about portfolio construction, and nobody knows what's best for the client than the advisor. And at Dimensional, you folks have done a great job of putting a systematic approach to all the tools that you folks offer on the fixed income side. So talk a little bit about that.
Right. Well, like you said, the advisor knows that client and knows their level of risk tolerance. So there's going to be clients that are risk averse, and there's going to be clients that are more risk tolerant. And I always say, look, there's no right or wrong to that. You are what you are. You have your favorite flavor of ice cream, whatever that is. There's no right answer. So what we try to do is offer a range of strategies where the risk-averse clients, they may say, look, I don't want a lot of duration in my fixed income portfolio. Or the risk-tolerant clients might say, I want to get a little bit of extra return. I'm willing to go a little bit more in duration and a little bit more in credit. Others might say, I can't bear the risk of unexpected inflation. So just give me something that's inflation protected, or I don't want to pay taxes. Just give me a good muni strategy. So we try to offer a whole array of strategies that the advisor could form that fixed income portfolio that's going to meet that client's needs.
Yeah, so you're touching on some of them. You've got the core fixed income ETF, the DFCF. There's the municipal strategy, which is DFNM. And then TIPS, or inflation protection, which is DFIP, and then finally short duration, DFSD. When working with advisors on a regular basis, it's really up to them to have the right mix and allocation for that fixed income side of the portfolio. Right?
Absolutely, and then focus on the right investment horizon, which the right one is going to be a long-term horizon. So there's always going to be chatter in the market about something, about whether now it's inflation or the Fed cycle. But I think if the investment horizon is properly set long enough, then you you act above that level of chatter and get the right allocation for your client, and that'll meet the client's objectives.
So Dave, dig a little bit deeper. Talk a little bit more about the secret sauce at Dimension.
So we see two main drivers of expected return in fixed income, and they're very, very straightforward. It's the term dimension, you know, am I buying shorter term bonds or longer term bonds? And the credit dimension, am I buying AAA rated bonds, or am I buying BBB or even BB rated bonds? So first, along the term dimension, there are decades of research to show that on average, when we're looking at upwardly sloped curves, we see higher expected returns and have realized higher average returns as you extend out an upwardly sloped curve. When the curve gets flat or even downwardly sloped, we don't see those excess returns farther out the curve, so we're generally not as willing to go as far out. And then along credit, when we observe credit spreads in the market, they ebb and flow. When we see wide credit spreads, on average, we expect larger excess returns for credit over treasury, and we have realized those through time. But when credit spreads are narrow, that excess return gets smaller. So we'll lean more into credit when credit spreads are wide, and back away from credit when credit spreads are narrow.
Dave, hey, thanks for carving out some time. It was great catching up with you.
Oh, you're welcome, Tom. Great to be here.